The broadcast is now starting. All attendees are in listen-only mode.
He drinks, he smokes, he cuts, he swears, he runs, and he runs. He lives like that, and he loves to fight. He's a loser. He calls me up when he's had too much. He's a schemer, a dreamer. But I tell him to change his ways. He just does to make us sad.
All right. Happy Monday. Ain't no quitter. How y'all doing today? Did everybody have a good weekend? Some of you are into your Monday night, wee hours of Tuesday already. Tuesday afternoon, Tuesday evening, Monday afternoon, Monday evening, Tuesday morning. I'll get it right yet. I'm just running on fumes here, not a lot of sleep, so sorry about that. Good. Great that the weekends were good. Yeah, I don't have much congestion today. I'm doing pretty good coming out of that cold. Dealing with a little bit of a torn calf muscle, but yeah, neti pot. Yeah, I hear you, Tim. Got to be disruptive to our sleep. Yeah. Sorry about that, Phil. Get better soon. All right. So today, February 11th, 2019. Fourth one of the season. Fourth one of this series. Spring is nearly here. Yeah. The weather's been kind of chaotic here, northern hemisphere in the States. We've had warm, we've had cold. but we're getting there. Yeah, far from here in Idaho. It just depends on where you are, right? All right, so today I want to talk about risk aversion, stops, and money management, because this is, very topical. So I want to come back and talk about tab 29 not being standalone. Tab 29 can be standalone, but it's much better as a confirmation system. You get to be much more selective, have tighter criteria, fewer trades, higher percentage wins, much less losses, etc. With that being said, we can attach tab 29 to just about anything, any model, any strategy you want, as long as it's not old paradigm. If it's old paradigm, you're going to have trade opportunities before the old paradigm trade, which may get you in early, or it may get you in compared to the old paradigm, or it may get you in too early, and then you have to use tab 29 to navigate your too early entrance. But so we know things like harmonic scans, things like pitchforks, things like trend lines. Tab 29 is an excellent tool with high percentages. Because there's a variety and diversity of ways you can apply it to your trading, there's got to be a diversity and a variety of ways you can apply risk and money management to it. Now, depending on where you are in your journey in Forex in general, depending on where you are in your journey in harmonic wave convergence, depending on where you are in your journey with tab 29, that's going to vary trader to trader. Just understand that tab 29 trading is about training, is about getting you a foundation. It's a starting point. There's left and right of what appear to be absolutes in the training. There is no absolute in the training. A good example would be last week with Clay, showing specifically the exceptions to the 80% rule, the 80-20% rule for a 20, let me rewind that. Showing the exception to the 10-minute wave being at 80 or 20 and a snake on a 30-minute wave. Or on a 30-minute retrace for that matter. And that exception happened to be using the 5 with a Bollinger Band hit that was, would be totally acceptable to take somewhere beyond the extremes. So not only the 10-minute wave is not the measure, there the 5-minute wave was, and you could use that rolling extreme, as we call it, to locate those points. And if they're tagging something else, if that pullback is tagging a Fibonacci, if that pullback is tagging a pitchfork or a trend line, it's super, super high percentage trade. Okay. So you learn the exceptions by being MacGyver, by being Magellan, by being the explorer, by being the CEO of your trading company, by participating in OCR sessions, by watching what happens in group posts and commentary there. Okay. But when it comes to risk, stops, and money management, that's trader's choice. So there's no set, hey, did you see that trade on the Euro USD at 9:30 last night? And everybody enters at the same price and everybody enters with the same money management. We don't have a system. Tab 20, harmonic wave convergence is a science. Tab 29 is a way of measuring that science. But again, it's applied against what you have going on. So I want to talk about that a little today. Did anybody see the move on the Swissy last night? Market open. So let's take a look at that real quickly, and then we'll come back to this. It's kind of like a breaking news. Let's go take a look at that, because I want to point out something about pitchforks with it. So that big blue spike you see, that's the 1700 candle yesterday, i.e., boom. Now, not to make myself look great, even if I am, but this fork was not in place, okay? But what was done was the fork used these hits to create the best fit, which then gives you a trade. So you want to be that MacGyver, Magellan, explorer, entrepreneur, CEO of your own trading company, and look at the market. Just take a look at what happened, because it'll bring you pips. Okay? Couple things you notice here. There's some magic woo-woo that's really interesting. And again, I like pointing this out because I'm a big woo-woo fan, and maybe some of you aren't, but I am. So a couple things we'll note here. First of all, this was a trend line hit. Off a significant swing low. Another reach with a big candle. And so there's your third hit. That's not so much. See, you got to put your mind in the right framework, guys. You can't say, "Oh yeah, I bet he really had that trend line there." No, I didn't. I'm not going to suggest I had that trend line there. This is not a trade that I took, so just bring clarity to this. I'm just showing you stuff on the charts to help you in your trading, and so you can do things. But by you manually getting on your charts and going back and seeing a point like this and trying to find a trend line will help you in the future then project that kind of trend line. Anywhere in here, you could have had that trend line drawn if the Swissy is something you trade. The Swissy isn't something I trade routinely. I'm not making that my excuse for not having it. I'm just making a point. But if you routinely trade something, you want to do your market analysis. You want to do, a little bit of setup work. And so I want to point out, don't just look for trend lines that are tops and bottoms. Don't just look for trend lines that are channel boundaries. Okay? It knew to reach to this point for a reason. That's in part some of the woo-woo. Now, some of you have noticed something interesting about that energy point. So the fork was manipulated to touch there. The fork was not there. The fork was manipulated to create that touch, or to take advantage of that touch. You'll also notice, and the trend line there. All right, so you have the trend line. But look at this, 89. Now here's the woo-woo in the chart. That 89 wasn't there at the time. Here's the cross that creates the 89. After that candle stopped there. So you get this feeling of somewhere in here, this candle knew that if it went up this high, from this point here, 64 candles averaged, including this average way up here, would create the cross exactly where it created it So back compliance would show the 89 right there. That 89 tag shows up after the candle was there and the new 62 cross occurred. This is woo-woo in the charts, guys. This is what I will tell you. This is why Fibonacci is so powerful. So it's okay you don't get that trade. Maybe you get that one. Now that you have it set up. Every time there's a wick like that, you want to go back and put a pitchfork on it and make that pitchfork hit that wick. Make the pitchfork be a boundary for that wick, up or down. And then watch the magic. Okay? Watch the magic. So anyway, I just wanted to point that out before we got into today's real topic. Kind of interesting. So risk aversion. Risk aversion is going to vary person to person. What seems totally natural and logical to one is going to be way outside the comfort zone of another. And that's important to understand and remember. So what somebody else does with risk, what somebody else does with stops, what somebody else does with money management, don't be comparing. You want to get familiarized, that's fine, but don't compare. Just go through your stuff. Now, the whole reason I want to talk about some of this is because there's just a scattered approach that, you know, some of it uses some of what you're taught in tab 29. Some of it is just made up. Some of it is somewhat random. It's okay to experiment. That's what demo account's for. Remember, demo accounts are your laboratory. But I also see people that are worried about stop losses, that are worried about risk, that are worried about money management, who can't yet trade shredder. So this is a misinvestment of your time, of your study time, of your learning time, of your demo time. Don't worry about where it can go. Don't worry about how much of a move you should be satisfied with. Worry about finding these harmonic wave convergences. Worry about setting up an alert system so you get the trades that you want to specialize in. Worry about your technology for the entry. Stop worrying about, you know, on your 20-second demo trade, how you could have gotten more out of a trade than you did. Instead, review the money management systems that there are. So that's what I'm going to talk about here for the remainder of the session. So the first thing you really got to know when you're in here and we're talking about stop losses is, what are you trading? Right? There's lots of things you could be trading. You could be trading 10-1 convergences. Well, and let's just go ahead and make this so everybody can play the game fairly. Maybe 15-1. Okay? Maybe you're trading 30 and 15 convergences. Maybe you're trading 5-minute Yeah, percent. It's only because people are watching I can't type. That's just so funny. Hello. Maybe trading 5-minute retrace extreme Bollinger Band touch. You know, and some have started to call it the Clay way. Maybe that's what you're out to trade, right? Maybe you're trading, 240-minute waves. Maybe you're trading 15, 60, 240 harmonic scans. That would be 15. Maybe you're trading pitchforks. And again, we cover all time periods, types. And then you've got money management to matrix across that, right? Now, those are just some things. I didn't put everything up there. I mean, IML folks, you might be trading Gold Cup and using harmonic wave convergence tab 29 to validate the Gold Cup pending order. On pitchforks, this is a place. Size matters in terms of money management, right? I mean, you can have a fairly small 15-minute scan, 15-minute fork. You can go all the way up to a 240 fork or bigger. Obviously, those are going to have different take profit thoughts. If the 15-minute fork is small enough and I'm doing a bounce off the bottom, my target very well may be, as a pitchfork trader, my target very well may be the median, and I'm using tab 29 to help me get to the median. But I got to pick one or the other. What am I trading? Am I trading the fork or am I trading tab 29? You can't be half pregnant. A 240 fork, obviously the opposite extreme. And so we can have lots of things we could do there. If from a fork perspective, if that's a wide fork, we may even have not just quads, we may have ox on it, 8 divisions. So you have, 4 targets in half a channel that you can hide stop losses behind. Harmonic wave convergence helping you, maybe. So you can matrix these things, right? What about, in terms of what you're trading, but in terms of money management, what else you can use to assist you in terms of once you've gotten into a trade? So you can use this as a trading system. Such as like cam lines, such as FEB pivots. Both of those, there are systems wrapped around trading both of those. Pivot lines systems, there's Camarillo line systems. There's a reason why H3 is, reverse and go short, and L3 is reverse and go long as a label. And so you may be using harmonic wave convergence to enter on a bounce on an L3 or H3 or another line, and then elect to use the FEB pivots or the cam lines, in this case cam lines, as stop movement. But then you'd want to make a study of it a little so you know exactly not to jam your stop, to give you some leeway. But it may be targets for taking profit and legging down. So we have cam lines. What else do we have in there that's pretty magic? Harmonic targets. You just saw an example of how lethal they could be. Of course, that was reverse compliance, but, we just, it's pretty powerful stuff. Now, I want to make a note on harmonic targets that, even though we generally place on 30-minute charts, you're really measuring, they're really based on a much larger cycle, somewhere between 4-hour and 8-hour. So you may get in on a 30-minute convergence. Think of Clayway, just scale it. You may get in on a 30-minute convergence that's a 4-hour retrace extreme. And now you're going to ride that thing up to another 4-hour convergence, 300, 400 pips later. It happens. So harmonic targets are excellent there. Harmonic targets are not designed for 30-minute trading because you're going to get confused between the harmonic targets and what the 30-minute wave is doing in terms of convergences and retraces. But you can slingshot the 4-hour, 8-hour pullback with a 30-minute convergence retrace extreme and ride that bad boy up. It'll go way past another 30-minute convergence, but now you can just keep going farther because you're using the harmonic targets and you're willing to, satisfy with potential erosion because of the bigger play that you're making. That goes all the way back to risk aversion. There are people who have created their own. We've got several people who have done it. I had one many years ago that I taught a handful of traders called SB21, and it was a way of trading the lower term charts, 5-minute, 3-minute charts, cycling between the 21s. But shadow bands are definitely a vehicle that can be used for money management. Sometimes trade entry, the retrace extreme very often shows up as a tag on a shadow band. All right. So those are good systems that are matrixed against TAB29. But you have to know what you're trading, what time period, what are you trying to achieve? Okay. With harmonic targets, I have to mention we did, we used to have a little magnetic. It wasn't so much a slingshot, it was pro trend, but the original Power 62 was based on a gravity zone. Once you got, crossing the 34 and into the 21, 87%. Where's that? To the 62. And that's all 30-minute. And then you can invoke your harmonic targets. That was long before we had TAB29, harmonic wave convergence, and multi-wave, and then TAB29. Long before. So there were no slingshots. We didn't know what a retrace extreme was. We caught the momentum of a power move, of that 8-hour move, of that 4-hour move, going towards the 30-minute 62. It was headed to something bigger, but it had just, that 62 had magnetic attraction. Even if it was going to serve as the point of retrace or a pullback on a 4-hour, 8-hour wave, it got sucked to the 62 87% of the time. What is the best INS for 15-minute trading? The one that gives you hits with TAB29 convergences and retracing streams? Yep, the one that works. Yeah, I'm not trying to be flip. I just see that what you want to get into the habit of doing when you do your chart work, when you do your setups, is to know what's happening that day. And the INS system, as it was built, is great for that. Okay, it's a resource hog, but it was built so you can easily rotate between the various INS systems. If you're going to have them running and just not displayed, they're still a resource hog. So the advantage of the way we built it as one indicator is your ability to go in there and click them on and click them off and click them on and click them off, and then see what's in compliance today. Realizing that at any time throughout the day, things can shift. Now, the systems that are daily range based, which include cam lines, which include FIBO pivots, which include DC45 and the DP30 system, those kinds of things are range based, meaning they're using open, high, low, close information from the previous 24 hours at 1700 to 1700. Things like harmonic targets, things like shadow bands are not dependent on daily ranges. They're based on Fibonacci and current movement. But you might get on the charts and see what is holding today for you during the time you're trading. We've said this many times. Some days Camarilla lines are just, you will be amazed to see the bounce off the H3 and it goes right on down to the L3 and bounces right back up. Other days it goes through the H3 and the L3, hot knife through butter, and it's bouncing off pivot lines. Other days you'll see the current 62, boom, hit 21, pullback, 34, pullback, 55, pullback, 89, pullback to the 72, pullback to the 55, that 89 sweet spot. So there's no best. It's the one that's working and has the most compliance at the time you're trading. But understand that could end at any given moment. You might go into a new cycle that is now predicting where tomorrow is going to go, just like that 89 hit on the pitchfork. That 89 wasn't there yet, but it acted as if it knew it was, and then it created the candles afterwards to make the 89 show up there. If you don't think the charts don't have intelligence, we're just on a different level. No, I think, it goes in too big of cycles. Now, see, when I talk about waveology, that includes harmonics. 24-hour ranges, and why we called it intraday navigation system is because it's truly for intraday. It's from one day to the next, and that's where cam lines and FIBO pivots, DC45, DP30, that's where that stuff comes from. Yesterday's range, today's range. You can have an 8-hour trade that spans 3 days. So the harmonics of the harmonic targets span several days. They're not day range based. The move is too big. It's not an intraday move. It's a swing/position move at an 8-hour level. And we've had, when all we had were harmonic targets, we'd have people in trades for weeks sometimes. Just getting more pips and getting more pips and getting more pips and getting more pips and advancing stops. See, the harmonic target system is a robotic system, and that's why it works so well, because you didn't have all this other stuff to distract you once you got at that level. See, if you understand waveology and you understand 4-hour, 8-hour waves, then the harmonic targets make total sense. If you're an intraday trader at the 30-minute level, you're going to have convergences up and down all the way up. And you don't even know you're in an 8-hour wave. But the harmonic targets work so well, with high percentages of people, 200, 300, 400 pip trades. Why? Traded like robots. It was a legging down system. We'd enter the trade, we'd take most of our profit at the 62, half our lots out at the 62. And then every harmonic target up, we'd take more lots out, 11 units, 7 units, whatever it was, 11. Hit another target, move the stop, take out another round of lot, take out another unit. A unit was a collection of lots, depending on how many lots you had in the trade. You divide your trade up, and I might have 5 lots in my unit, you might have 3. Somebody else might have 17. Just depends on your capitalization and your risk. But the unit is what we exited with. You exit 1 unit here. For some, that'd be 3 lots, or 5, 7, 17, right? But what made it successful was the robotic trading of it. There weren't distractions to do other things. Your mind didn't wander. Your RAS didn't wander. It wasn't, oh, this is Elliott wave XYZ to the 3rd power of the 3. It wasn't, oh, this is a 1 hour retrace extreme, not at extreme, but hitting a Bollinger Band. None of that. What happens if you got profited out? You celebrated the profit you made at the last target because you laid down at the last target and it pulled back and profited you out with the remaining lots. It was like, okay, I'll get into the next one and I'll do the same thing. It was 100% robotic trading done by traders manually trading. It's an excellent example of why I try and reinforce trading robotically with whatever is you're trading, because you have distractions left and right that our traders didn't have, my traders didn't have, I didn't have when we were trading Power 62 and harmonic targets. This is why up above, TAB29 will accommodate all these things. You have to just decide which ones. Move that aside for a second. I want to talk just a second to break even plus 1. What's the danger of break even plus 1? Well, actually, there's 2, depending on what the totality of what you're trading, in terms of money management. But what are the 2 of the top 10 dangers of break even plus 1? Yeah, we got a lot of stuff here. So we got spread, we got letting things breathe, we got not letting the waves do their thing, pullback, spread, depending on how you're calculating your break-even plus one. Doesn't allow wave two to form. Kind of the same thing in terms of letting it do its thing, watching, waves. The first danger of, well, as I consider it, one of the bigger dangers of break-even plus one is it is 100% dependent on where, excuse my writing, you enter. So think about that. Why are you so important? Why is your particular entry so important that the market's going to allow it to be respected? Back to the brokers with their 5,000, like CIA or NORAD headquarters where they've got the, 16 by 16 monitor matrix on the front wall that's the size of an IMAX theater screen. And in a heartbeat, the director, let's look at monitor one. And they blow monitor one up to be the entire thing. Oh, Zoe's on. She's trading now. Look where she set her break even. Let's go chase her stop. The market doesn't care if you trade. The market doesn't care where you get into the trade. And when you use break even plus one, you're saying I'm trading randomly. Because obviously the break even is one is 100% dependent on where you enter the trade. And so, like I've drawn many times, and again, it depends on what else goes hand in hand with your break even plus one. But if you're in a move that goes like that and you enter here and the move comes back like this, well, your break even one's here. Even if you say, well, I'm going to get 5 pips up. You entered at 10 pips, here's 15, you're 5 pips up, you invoke your break even plus one, here's your stop. And yet we know 73% of the time the turnaround for wave 2 is going to be between 50 and 61.8. Now, if you've cleared wave 2 in a shallow move, see, now people can be saying, well, Steve said not to use break-even plus one because it's not their thing to do, and that's what they pulled away from this. It's not what I said. I gave an example of break-even plus one not being a really solid strategy if you're just aggressively going for the move going up and you've earned some pips and you got in late. See, it's dependent on where you got in. Break-even plus one is not really a valid strategy for POT trading, so mixing the two is not really good. Know what you're trading. So it's dependent on where you enter, and then the second one is most of you were hitting, the wave 2 reality. The second thing that comes up with stops, risk, and money management is regardless of where you set your stop, when you're doing stops and you're not POT trading, maybe you say, okay, Steve said 50 to 61.8, so I'll have my stop loss at 65%. Well, we know about 12% of the time you're still going to get taken out because it can come all the way down to here. And below the 61.8 down here, we're whatever, 12, 15% of the time. Depends on where you want to flip your numbers, but somewhere in that range. So set your stop loss at 65, you're still going to get taken out 12%. And the wave 2 still form and take off. Does prevent further erosion in case it does all the way reverse on you. Now, this also applies for the 40%. 40% can be used short term on a 1-minute chart. It could be used on a 4-hour, 8-hour chart. Depends on how you're trying to apply it. But get over the, I used 40% and, it wicked me out and then went on 100 pips. Well, if you're at the 1-minute 10 level, then quit complaining, learn POT trading. Now, for those of you that are a little overwhelmed with what I'm talking about, information overload, taking a sip of a drink from a fire hose, as they say, it's okay. It just means you need to focus on your entries right now. You're not ready for this. It's not a matter of being overwhelmed. It's you not being ready yet. And that's okay because this is going to be recorded. The one thing you need to remember if you're not ready to hear this right now is know what I'm doing, know what I'm trading. You're not trading robotically if you set up a system and it includes 40% and you get taken out and you're worried about the time that 40% was a wick in, maybe you miscalculated the spread. Maybe you weren't quite accurate at drawing the Fibonacci, whatever. It doesn't matter. Maybe that big monitor at NORAD did see you and they took you out by a pip, including spread. And then it went up 100 pips. You know what? Here's what happened in that trade. Was you got those pips. That's what happened in the trade. So instead of worrying about the dang 40% wicking you out and, oh, if I just had this, oh, I wish, oh, celebrate the pips you got and go do it again. This is not the last trade in the Forex. Get past it. Put your big boy pants up, your big girl pants on, and get past it. This is not the last trade in the Forex. Do the Charlie Brown dance. Did your equity ball stay the same or get bigger today when you grab 60% of the move? Yes. That's reason to celebrate. You take 5 trades today and your slush is essentially net zero. You celebrate. Because unlike other traders who lost today, they lost and they're down. You got out of trades at slush. Celebrate. You guys got to get your mind in the right direction. This is why you struggle. Because you're not celebrating your victories. You're focusing on your losses. And guess what? We get more of what we focus on. Celebrate getting the positive pips here, and in time, learn more. Don't go and try and change up your money management because you got wicked into a 40% stop out and it went 100 pips afterwards. Celebrate that. Celebrate it. Celebrate it. Then learn. And the reason you're even at 40% is because you're not in short-term charts, because you're not POT trading. Well, sometimes I get out and I can't get back in because it's not a real strong 2 to 3 move. And even if it is, who cares? Celebrate the pips now even more than what you had in the 40%. You got out up here. And now you made extra pips. But now you're crying because I couldn't get back in the move. Go get another 60% of the move, 70% of the move in another trade. Forget what you didn't get. Jeez, I don't get it. This is why the head game is big and why some of you are just missing it. You're focusing on the wrong things. I'm not saying satisfy with, not being able to do more. I'm saying don't make it your big focus. Celebrate this. Say, I'm awesome. I did what most traders today can't do. 95 to 99%. I made positive pips in my trade today. Celebrate, celebrate, celebrate. Then work and celebrate some more tomorrow, and then work, and then celebrate some more tomorrow, and then work, and then celebrate some more, and then work. And soon your mastery will come and you're going to start getting more of those that used to escape you. But if you try and get those that escape you up front, you're never going to get to the trades that even make you positive pips. You're going to screw your mind up so much, it's done. Why do we have general rules for newer traders? Because we want to put the odds in your favor? Don't worry that I posted a trade, or Zoe posted a trade, or Tim posted a trade, or Anthony, or Beryl, or Clay, or Daniel, Jerry. We got too many names to rattle off here today. Forget 40% stop loss. Forget haul. When you've got a steep move, your stop loss should be a line outside your pitchfork. Now, if your pitchfork's ranging, if it's a very low sloping pitchfork, then yes, other money management's better. If I've got a channel or a steep pitchfork like this, and it's shallow, we're in a shorter term chart, let the stop loss be a line outside, but that's because this is an up move. In up moves, we are buying because that's where the high percentage thing is. Bottoms. Why? Because if this is really an active trend line, if this lower parallel of a pitchfork, if this trend line is really doing its thing, and price wants to take off from a point here and test it, you're back to a starting point in terms of the bounce off the trend line, but your stop loss now is advanced. Here's your stop loss. Here was your stop loss. That has advanced. So retests and breaches in a failed retest take you out, but take you out for profit, positive pips. When you sell from the top and it retests, your stop loss has grown unless you're using something else. And if you're using something else, such as a horizontal stop loss mechanism, oh, look, I'm break even plus 5. I'm 5 pips up. I better put my break even plus 1 on there. So you put your break even plus 1 on there, and it comes back to retest. before it does its big move. Not that that's a wave 2. This was just an extended move because we had a big move up. It was a retrace. It went up to test again. But you're going to miss the big move because you took yourself out here on your break-even +1 on a sell in a buy channel. So the whole reason buy on bottoms in an uptrend is so retests and the eventual breach are in your favor. Oh, it broke my fork. Big deal. Took you out positive pips, but you're going to cry about it. Or you're going to take the sell at the top and then cry about how trend lines don't work or channels don't work or pitchforks don't work because you're taking it counterintuitive. But remember, oh wait, Steve, what the hell are you teaching us? Because after all, this is the harmonic wave convergence. Aren't we a contra system? Aren't we a reversal system? We're supposed to be taking the harmonic wave convergence trades. In an up channel that's steep, asterisk steep, asterisk steep, asterisk steep, the strength is up, even though technically impulsivity is down. The strength is up. This buy into the sell is stronger move than the harmonic wave convergence. It's greater than the harmonic wave convergence. Not only in strength, but in pips possibility. So you only take that, yes, when you've already captured some of these attempts. And you have positive pips. Now you want to take this because this may be the big move. And what's it going to cost you if you're wrong? -3. But gee, you made 18 pips up. Who cares about the -3 attempts? Ditto on the sales down. Same thing. You got a stop loss. And on these tiny charts, guys, you don't need 10 pip stop losses. If it breaches the channel, you want to be out of the trade. Put your probabilities where they work. 5 pips, 2% to a 5 pip stop loss on a channel that's proving itself, on a trend line or a pitchfork that's proving itself. And now if it wants to retest a line before doing a drop, you're okay. If that retest fails and it breaks, well, from where you entered to where you got stopped out, you made pips. So the move in terms of the channel failed, but you exited the trade positive. This is swinging the bat in a strike, but you don't get it count against you. And the reason in a steep move you forget the 40% is because very often 40% is going to hurt you. It's like you're not, that's why I say know what you're trading. Remember we talked about these strong moves up, these impulsive moves, the one we highlighted the other day. Remember, natural pressure on the system is eastbound because moving up, every time you have a new candle, where can it go? It can't go to the left. It doesn't stack it on top. It puts it to the right. So on a chart, your channels get steep, but the price moves to the right, and that's in your favor because what it means is as you leave a point on the chart, every time you have a candle close, it moves it more to the right. Notice how this works in your favor as we climb up the channel. But that same reality is in place. Now you've got two things going on for you in terms of the pullback. You still have that eastbound reality of the next candle, but you also have this massive upward force. This is why the channel's so steep. So it's very hard for this price to come back in a steep channel. It's very hard for it to come back even to 23%. It's a challenge in a steep channel because these forces push the candle to the right, and this forces it up, so it ends up being a very stubby, short pullback. And here you sit with your 40% retrace. I don't know about you. I'd rather be taken out here. Than down here when it breaches my channel. Know what you are trading. Don't just go stick 40% on everything. Sometimes it doesn't make sense. Come back to my little notepad. Update it a little. Steep channels. Buying to the sell. Selling to the buy. Forget. 40%. Use fork / trend line stop line. In those steep channels, the stop line is always going to be much less than 40%. Another strategy, and this is why I said the Power 62 when we jumped into a 62 trade and we used the harmonic targets, why everybody was satisfied even when they got profited out is because they were legging down. Now, this is early on. So people were happy with that because they were profiting along the way. You can use this in short-term trading. I surely wouldn't use it on a 1-minute chart with an exception. With a 1-minute wave, you might see it on a 1-minute chart. So legging down is very easy to do. You know, those of you who were, are whatever, IML, and we started trading harmonic scans. Those that are not IML that are trading harmonic scans with the new scanner that we're using. The strategy there on most scans, not all. Some, again, know what you're trading. Some scans, the targets are not, whoops, got that backwards for what I'm doing here. Sometimes the targets are not just evenly divided the way we see them sometimes, 38, 62, 100. Sometimes they're using the B, the X, etc. So know what scan you're trading, what the targets are. But in these targets, if there's 3 general targets for the scan, then we're legging down 1 here, we're legging down 2 here, we're legging down 3 here. That's the standard way of approaching it. There's hybrids off that. Remember, we don't exit a trade just because our candle tagged that line. We want to see it tag it and go past it and then start coming back, that's when we would take profit. But if we took out a third here, and we took out a third here, and we took out a third here, that would be a harmonic scan money management. We can overlay that with an at time period haul. And if this moved up and it goes past this blue line and it starts pulling back a little and you would normally exit there, maybe you take that third and divide it in half. So you exit 1/6 when it comes back and tags the line, and you leave the other 1/6 to run with the haul. So for 3 targets, you use the targeting system of the scan. But instead of taking yourself out here, why do you do that? Because sometimes this move goes like that. And why not do something to capture a little of those extra pips? So let me talk about legging down. Makes sense because it satisfies your psychological side. I could prove to you mathematically, especially on harmonic targets, where you can actually make about 5% more by not legging down, but just appropriately moving your stop loss. We used to move stop loss and leg down. But if you just move your stop loss instead of legging down, you can actually make about 5% more on average over a volume of trades. Well, then that's what I'll do. Well, the trouble is it creates psychological dilemma. Especially in those moves where you end up taking yourself out and then the price continues. So you find that legging down satisfies the psychological side a whole lot more. It's not the most profitable way mathematically, theoretically, hypothetically on paper or in a spreadsheet. It is in terms of your trading. And that includes all the way down to a 15-minute or 10-minute wave convergence. Oh. Remember, even here, there's so many things you can do. You can go 10 to 10. I want to go 10-minute convergence to 10-minute convergence. Period. End of story. I don't care if I get 90% of the way there and then it comes back and takes me out. I was up 15 pips. I'm -3. Because if you do it robotically, you're still going to end up making positive pips. So again, your tolerance for risk versus risk aversion. It depends trader to trader. There's no one cookie cutter money management that's going to work best for everybody. But let's say you were 10-minute wave to 10-minute wave. We know sometimes a 10-minute wave likes to snake in the short period. We know that, the 1-minute wave might have been POT cycling that 10-minute wave up, and it finally gets up here. And in all terms and purposes, we have our 10-1 harmonic wave convergence at extreme. And so if I'm going convergence to convergence, this would be my likely exit. Unless you took out 80% of your lots, you let 20% ride, and you look at where you are right now on your 15-minute haul. Is it still green at this point? If it's still green at this point, what can we set as an ESL? for the last 20% of our lots? Let's think about this. It's a test question. See, this is why I like, this is a point in time where I like GoToWebinar much better, GoToWebinar, than I do Zoom or the IML TV chat. Because not being able to see the answers that everybody puts in there makes you more likelihood to submit an answer. And so you get to exercise your thoughts, and I get to see those thoughts. So if I get to the extreme here, I have my 10-minute harmonic wave convergence, and I'm looking at my 15-minute haul up in price, and my 15-minute haul at that point is still green. We know something about the haul. We know from the peak in price, on average, it pulls back 23% before it would flip color. So if it even hasn't flipped yet, meaning there's a likelihood this value is going to go up higher, we know 23% should be on average a very safe stop loss to put in here. Which means for these remaining 20% lots, we're going to make 77% of whatever the pips are we made at this point here, no matter what. And so now our risk reward, and it's only 1/5 of our lots. So the actual net down impact is very little by staying in this trade, exiting 80%, staying with 20, and letting that 20 run, because this just may take off to be something crazier, especially for the fast 33 traders, where this could have been a 30-minute move, could have been a 4-hour move, and this thing just, in terms of it's going to cycle and go up and go up and go up. Can't go out of the box like that, but you know what I'm saying. Go up another 100 pips. So yeah, this is what does Steve as a trader do the math? I'm always looking at the math perspective, because what? By putting probabilities in your favor, that's how you're going to make the most money. Doesn't guarantee success at big levels 100% of the time. It guarantees optimal success most of the time. So if you know something about the haul, and I don't know how many times, Zoe's been here forever, Tim's been here forever, Mark's been here forever, I probably said the haul average is 23% on a volume of trades as the average pullback before it flips. So knowing that, there's no reason to use 40% if you're going to stay in this trade with anything. Now, you could go harmonic wave to convergence, and exit everything. That's a money strategy. There's nothing wrong with it. But if you're open to a little bit more risk for a lot more gain, it's not that risk isn't going to put you in the negative. It's going to take 23% off of 20% of your lots. So all the rest got 100% of the move up to there. And you're going to have 20% lots, at 23% or 77% of the move. Now, as I teach, I'm going to teach the haul, the multi-time frame haul tonight for my Disruptive Traders TV at 5 o'clock. So I'm going to teach the multiple time frame analysis haul with bands in more detail than I've done in the past, and record it. It's going to be it'll be part of the Fast 33 training, but it's the same for TAB29. It's no big difference. So this is that. What else? So I have legging down as a strategy. The last one we could really talk about, which is really fun, similar to legging down, is CBT. Our word for hedging when positive. Don't hedge negative. Hedging when positive. And again, I don't care what time period you're at, the concept's pretty simple. I come to a place down here, I come to a place up here, and price pulls back. Now, this is similar to using the Hall. I don't want to do it on tiny moves. I'm not interested in, I'm up 10 pips at convergence here on my 10 or 15 minute wave. So we're talking about a move that's really stretched out. Maybe it's a 30-minute convergence. Maybe it's a 10-minute wave convergence. Maybe it's a slingshot off of a pullback of a 30-minute convergence, and you've ridden it up from your entry up. Now you're up 50 pips. Well, again, if this was nice POT cycling up to a top, that is a harmonic wave convergence. Harmonic wave convergence to harmonic wave convergence, there would be your exit if that's all you're doing. But maybe you're adding the Hall to it. So you're legging down. Take most of your profit. And or maybe you're going to hedge. So now with equal lots, you enter the sell without exiting the buy. It'll be recorded. So equal units, equal lots. I'm just going to enter. And now I can control this pretty tight. So if this actually was the convergence and it's reversing on me, my buy gets stopped out. If it's going to snake, if it pulls down a little and only goes back up, well then my sell gets stopped out. So the reality is in this area in here, we have a net neutral zone. Nothing's going to count in that area. And therefore, if this reverses down like we think it should, your buy gets exited a little less than at the very top. So you would have had max pips here, indeed, if it was a reversal. But your buy does get exited out there. But the difference is you're now in the sell. So if this is a big move, you go, aha, I exited up here. I would have been stopped out. Otherwise, you're right, except you didn't get these pips because you exited the trade without entering the hedge. So you're right. That's optimal point right there. That white circle right there. Boom, boom. Optimal on the buy. Optimal for the buy. On the, HWC to HWC exit. The only thing is, if it's really the reversal, which is why you're getting out of the trade, you're essentially saying, I believe this thing is not going up any higher. That's why I'm exiting my buy. Isn't that acting in conflict? If you think it's actually ended there and it's going to be a reversal, why are you not entering the sell? Well, now, here's a good question. What should be the stop loss in the sell? Test number 2. We're going to end here in a second. What should be the stop loss for the sell? Clay, Jerry, you're right on. Yep, got it, Zane. Yep, you got it, Alex. Yep. When the double top breaches, when you go past, because see, if this continues up, this was not a reverse. This was not a reversal. It was just a small retrace, and the force is up. So that tells us this is not the wave 1, and this pullback up here is not the wave 2, because the wave 2 would be breached right here. So just somewhere in here is good enough for the stop loss on the sell. It's tight. But just think about that. I want you to, when I end this, think about, why are you exiting here? What is your logic? Well, it converged. It must be reversing. Participate in the reversal. Now, again, we're not talking about, I just entered the trade. Oh, my 1 minute wave is at the top. I guess I should enter a sell here. We're not talking about 1 minute scalping moves where we're trying to hedge 3 pip gains. That's not what we're talking about. Notice plus 50. Yeah, but I might lose 2 pips from my 50, Steve. Yeah, exactly. See, this is a robotic psychological move because it says no matter what happens in this zone, I'm not going to be hurt. Because it's either going to advance in my direction or it's going to reverse. And either way, I'm picking up pips. What's going to happen down here if it starts to reverse and it turns around and goes up? You're in the sell, but your stop loss gets bought out. You know, it gets stopped out. Your buy gets stopped out. You're in the sell, and it comes down here and reverses. How do you know when to get out here? Well, if this is a 10 or 15 minute trade, how about, I don't have purple, how about when your 5 minute wave comes back and your 1 minute wave goes to extreme and that 5 minute wave is hitting a Bollinger Band? Oh, Clay wave retrace extreme. That means the sell is done. Exit the sell. It doesn't matter where I got stopped out in the buy because I made all of those pips down to the sell. Oh, so I went, you know, it doesn't matter where I get stopped out in the buy. Because the sell here gives me those pips back. So what this hedge does, continuous bidirectional trading in this kind of situation, it says whether this reverses or whether this advances in your direction, you're going to win. Wait a second. How many times you plus 50 in a trade and price is hesitating on the charts, does a pro trend trader get to make a decision to say, no matter what it does from here, I'm going to win? Again, you know, I apologize to the guys that are like, you know, 2 weeks into TAB29. I know this is way, way like up there. Yeah, right, Mackenzie, all the time, right? I know this is up there. But, you know, the good news in that is, hot damn, look at what I get to someday. Just keep doing what you're doing. Persist without exception. Keep pushing. Yeah, I'm going to take a question or two, and then I got to call it a day because I'm trying to keep this to 60, and I'm at 90. But I did hit the topics I wanted to at least hit on. So, How long do you wait for 10 or 15 minute waves to move out of an extreme at harmonic wave convergence? No, I'm not sure I understand the question. You mean if it's stalling at the convergence? Almost any time it stalls at the convergence, it's got more impulsive, it's got more momentum, it's going to continue to go. We've talked about that in terms of trade entry. I mean, oh my gosh, a long time ago. You know, if I come up and there's my convergence point with price, you know, down below, it's converging there, and it starts coming down and does that kind of thing, we're out of that. We're not going to be in that cell, because that's just a continuation correction. It didn't, that should be a hard wall. It should move down even at the 1 minute level. It should have some impulsive look to it. That 1 or 2 pips sideways, 1 or 2 pips sideways. It's just stalling. What's going to happen here is it's going to go up higher. Do you have what you'd consider a 10-10-10-1 convert? I don't understand that question. Sorry. Yeah, if I'm in a cell here and it's stalling like that, I'm exiting. If I've already exited here because I'm exiting, my buys routinely, convergence to convergence, well, then I have nothing to worry about. But if I've hedged this, then I'm exiting my sell with that, because it just says there's too much momentum up. Remember, you're hitting a hard bottom. Does that look anything like a wave 1? No. On a hard top. On a hard top, that does not look like a wave 1. And so you bail on it. But guess what? If you entered the sell at the very top, boom, and it's doing this on you, you don't wait, by the time it gets here, you're out of the trade, and that should at least cover your spread. So your sell cost you nothing. But it's time to get out of the sell because it's going up. That's just a standard correction pattern. No, I'm not going to say candles, because candles have different lengths, but generally my rule there is I look at that first pullback, and if the second pullback doesn't beat it, and this is very narrow, this is very shallow for what should be a wave 1. Your move is like that. And that's way too shallow for a wave 1. And this is not, the 2, and this is the 1-2 of the smaller one. No. This first one just didn't get far enough. There's too much impulsivity still up. Yeah, Bart Simpson's hair. Yeah, Steve Channel is, 40, 45 degrees. Yeah, we're only talking about winning setups. We're only talking about, we're not talking about slop. I mean, it's like, why? Don't even entertain it. Only take the trade because if you take it, you're going to win. So if I'm hedging, I'm not doing that in a sloppy manner. If I'm hedging, it's because I know my sell could look 10 out of 10 but that the buy can still go on, because that's what the beginning of a slide, that's what the beginning of a snake looks like. It looks like the ideal convergence. The hedge is about saying, I know reality. I know a good percentage of the time that 10-minute wave is going to snake some. But I wouldn't consider a sell on a hedge on a buy if the sell looked iffy. So, in that case, I just exit the buy too. Or you can put in the haul. See, it just depends on where your risk is. Here's a good example. So some of you know about this artificial intelligence software out there, and there's battles going on back and forth between two companies and their chit chat and, blah, 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 blah. But one of the early adopters, call them a defector, whatever you want to say, the other day, there was an alert put out for the subscribers to some of the AI software, and the alert said, exit the Aussie dollar. Take it off your charts. Do not trade the Aussie dollar. And so there was a trader, based on their risk aversion, what they've done over time, said, I'm not going to do that. And they paid a price for it. It cost them a lot of money. A lot of money. Because sometimes the thing about, even artificial intelligence software with a lot of hooks, if you're doing the wrong thing outside of the parameters of the system, you can get hurt. So he wrote a post about it, and then he came back and he said, but guess what? I don't use the settings the company has in normal trades. I use much more risk than the company does. And so when the standard settings get good results, the way he trades, his risk, he gets great results. And so when he has a mistake that nobody else had, because they were using the settings because they disabled the Aussie as tradable, and he sat in there with higher risk and trading the Aussie, let it trade the Aussie for him, he took a big hit. It scaled, guys. But the people who have standard settings, who have little gains, saw his loss. They forget to place it in magnitude. When they're making $1,000 on a trade, he's making $25,000 on a trade. Because he has not just more capital, but he's using higher risk. So, higher risk, bigger reward, but higher risk. This is true of your trading. I don't care if you're on a $200 account. Well, I can make a lot more if I put 5% into the trade versus 2%. Yes, you can. But when you have something happen and it goes bad on you and you pull back 30 pips instead of, what you're used to, that cost you 6%. Whoop-de-doo. But not if you had 5% in there, it cost you 15%. So if you're a conservative trader, you don't sit there in envy, in jealousy of the traders who take big risks and make big gains. Likewise, if you're the conservative trader, you don't look at somebody who gets those big gains, and when they have an occasional loss that's big, go, oh my God, look at what happened to his account. Because it's scaled out of the way you think. You're not going to take the same moves as a TAB29 trader on a 10-minute trade that George Soros took, when he shorted the dollar. You're not going to make the same kind of losses that a Wall Street hedge fund trader makes when they're wrong. Because you don't make the same kind of gains when they're right. So it's all based on your risk aversion, and how you play. Now, if you're trading something, this is the whole point of KSP and demoing, and Tim just mentioned this. Tim Packus just mentioned this. This is the whole point of KSP. If there is a move on the chart, what would be a classic move on the chart that if you've traded, not just theoretically from what I've said, but if you've traded, we're going to end here. A classic move on the chart. Maybe it's a scan, maybe it's just a nice, traditional fork that you have, and price comes up, and it comes back here. And you say, one trader says, that's a retest of the pitchfork. Another trader says, that's a retrace of the pitchfork, but here's my 38, and here's my 61.8, or here's my 50 and 61.8, and that thing is smack dab in the middle of it. That's 73% of the time where price turns around for the wave 2. Wave 2 turnaround. And that is bouncing. At the time it's hitting that 73% of the wave 2 turnaround. It's bouncing off the lower parallel. And there's some energy point there. Make it another color. There's an energy point there. So it's in the 50 to 61.8 zone. I've got an energy point, and it's bouncing off the pitchfork. And you know that from this entry here on a traditional fork, there's an 80% chance of getting to this median. At some point, we don't know when, could have been here, still might be down here after a second, third, fourth test, who knows, but we know there's an 80% chance right here, we're still living with that 80% chance. So this might be that trade that instead of 2%, you go in at 3%. Because you've seen this happen way too often, too idyllic of a setup. It's okay to go in a little bit stronger. It's not financial investment advice. I'm just saying consider the math based on probabilities. So if you see something that happens consistently, the math's involved in it, and you can stack those probabilities, then you can scale it either when you're consistent with this or when you see this. And if this is small enough and tight enough, and again, your risk aversion is big enough, maybe you have a 5 pip stop loss instead of 10, and you're putting your 2% into a 5 pip stop loss versus 10, and now you're putting 3% into your 5 pip stop loss. 5%, 5 pip, sorry. And so this trade goes up and POTs you, and you exit at plus 15, and a swing trader who's used to his 100 pip stop losses and his 150 pip gains laughs at you. Oh, you exited that trade at 15. That ain't anything. And you're laughing because you say, yeah, I just made 10%. Never lose sight of the math. Going to call it here. All right. So for those that can hang in there, Disruptive TV, 5 p.m. tonight. Otherwise, I'll see you guys on Monday. Have a great week. I'll see you in the Facebook groups. Remember, life can be short. So for those people who care and love, let them know you care and love them. I love you guys for being here. A pretty decent turnout. Appreciate it. Hopefully you got something of value today.